If you're an American living in Canada or planning to relocate there, you might wonder what options you have with respect to retirement accounts you've left behind in the US. Although we are well versed in all cross-border retirement plans, we'll center this video on cross-border financial planning considerations with respect to a former US employee's 401k account as a current or future Canadian tax resident. Whether you've moved to Canada or are just planning to relocate, it's imperative you understand your 401k options. The most common choices include leaving the assets in the 401k, rolling the present value to an IRA, converting part or all to a Roth IRA, or withdrawing the money as cash. Each option has its own pros and cons, as well as tax implications that you need to be aware of. Let's look more closely at each one of these options. The main advantage to keeping the assets within your 401k relate to future Canadian taxation of withdrawals, specifically when a married couple looks to income split during retirement. If the disparity in income between spouses is sizable and the 401k account holder has significantly more income than his or her spouse, then future 401k withdrawals can be split with the spouse who's in a lower tax bracket, thereby reducing total household tax in Canada. There are two main downsides to this 401k option. You may be stuck with the mix of securities you have on the day you leave the US, or the menu of investment options narrows dramatically. Either way, the performance of that old 401k suffers. For this reason, it usually does not make sense to maintain an old 401k after you leave the US. This is one of the reasons why rolling the present value to an IRA can potentially make sense. The disadvantages of keeping the 401k with your former employer are avoided by rolling the 401k to an IRA. Investment options dramatically increase and the handcuffs on trading are removed when instead the account is managed by a cross-border investment management firm that is licensed in both Canada and the US, such as Cardinal Wealth Management. Rolling the 401k to an IRA can potentially maximize asset growth and allow for broader control over the investment architecture as life goals change. It is important to note that a direct rollover of your 401k must be reported on your US return, but no tax is actually due. The rollover is tax deferred until you take distributions from the IRA at a later date. To assist you in preparing your tax return in the year of the rollover, you will get two tax slips, one from each end of the 401k rollover transaction. The 401k custodian will issue a tax slip called a Form 1099-R, and the recipient IRA custodian will issue a slip called a Form 5498. The information on these two slips should match. Your tax preparer will record this information on lines 5A and 5B of your U.S. tax return, IRS Form 1040. Another option for your 401k is a conversion to a Roth IRA, which is quite different from a traditional IRA. Unlike a traditional IRA, a Roth IRA allows for asset growth and retirement distributions on a tax-free basis, assuming certain conditions have been met. This is due to contributions or conversions being made on an after-tax basis. It is extremely attractive to possess tax-free income as a Canadian tax resident, as generally speaking, Canadian income tax rates are higher than in the US. Therefore, converting a portion, if not all your 401k, can be a strategic cross-border financial planning tool to help mitigate long-term household Canadian income tax. Normally, one needs to have severed employment in order to leverage the 401k conversion option. Keep in mind that any Roth conversions create a taxable event. This is because most 401k plans receive contributions on a pre-tax basis. The greater the time lapse between ceasing employment and establishing Canadian residency, the better. In fact, this strategy is best employed over a multi-year period, especially with the larger 401k accounts. Why over multiple years? Recall that the entire conversion amount is treated as taxable income in the year of conversion. A very large conversion could push you into a higher income tax bracket for that 1 year. Not a great decision. You would pay more tax than you need to. Instead, consider converting smaller amounts over multiple years and try to stay in your current tax bracket. In this way, one could convert a portion or all of their 401k to a Roth IRA, filling up lower tax brackets annually until a shift to Canadian home tax residency occurs. The Roth conversion option surrounding your 401k is only advantageous when performed on a proactive basis prior to Canadian tax entry date. It can have dire implications if executed as a Canadian resident. Equally critical is to understand what tax reporting is required upon establishing Canadian tax entry in order for the CRA to validate the tax-free status of a Roth IRA as a Canadian tax resident. To be specific, per paragraph 7 of Article 18 of the Canada-US Income Tax Treaty, a specific tax election is required on the Canadian startup tax return in the year of entry. In summary, this strategy is complex and should only be done with a competent cross-border financial advisor. We can guide you through this process at Cardinal Point Wealth Management, ensuring that your decisions align with your long-term financial goals. We can help you decide on the amount to convert, quantify the U.S. tax implications, execute the logistics, and leverage specific Canada-U.S. income tax treaty elections to substantiate this strategy. Many 401k participants are tempted to cash out their 401k to help simplify their financial affairs when living in Canada. This option is the least attractive because of the tax cost. Not only is the tax bill large, but it may throw you into a higher tax bracket for that year. If cashing out the 401k prior to Canadian relocation, the entire account value would be included in U.S. income for the tax year in which the distribution were made. Furthermore, if the holder were less than age 59 and a half, then in most cases, an additional 10% penalty charged on top of the regular income tax would occur. If executing this transaction as a Canadian tax resident, the Canadian dollar equivalent value of the 401k withdrawal will be fully included as ordinary income on the holder's Canadian T1, which could result in an approximate 50% income tax in Canada. If the individual were also a U.S. tax resident, then a foreign tax credit could be claimed on the U.S. tax return for Canadian taxes paid to avoid double taxation on the 401k cash out option. It should be noted, though, that one's U.S. immigration status is important, as it may require a minimum 15% tax withholding at source on the 401k distribution. For these reasons, the lump sum 401k withdrawal is rarely utilized. Living in Canada with U.S. retirement accounts like a 401k present unique challenges, but with the right strategy, you can effectively manage these accounts and secure your financial future. At Cardinal Point Wealth Management, we specialize in cross-border financial planning, helping you navigate the complexities and managing retirement savings in both Canada and the U.S. If you found this information helpful, don't forget to like, share, and subscribe for more insights.